Welcome to the BCI Business Brokers and valuatebusiness.com.au business valuation model. Business valuation is complex, but it doesn't need to be too complex. It's much easier if you follow the logic. So the first question that a business valuer or broker is going to ask is, what is the income return? Is the business making money? If the answer to that question is no, the next question is, does the business have special value? So that means even though a business has no profit or no return to owner, it could have value outside the normal realms of business valuation. Does it have certain intangible, intellectual property? Something that a buyer might want that doesn't relate to its current income but could be very valuable to a buyer. If the answer to that question is no, we're then left with an asset valuation method. Look at the three methods we include here. The first one is depreciated value. This is the value you'll find in a depreciation schedule. It could be an accurate value, but it could be less or more than the assets are actually worth. For example, the government allows us to depreciate assets at a set rate. If the assets haven't depreciated and haven't lost value at that rate, well, the depreciation value is not accurate. Secondly, net realisable value. That's the value that we can achieve for the assets in an orderly sale right now. It's not fire sale, but it's net realisable value available in the marketplace, less any costs of auctioneers or middleman. Thirdly, we have going concern value. This is the highest value generally that assets will attract. It's the value of all the assets in situ, plugged in, business ready to be opened tomorrow, and everything's there that's required to operate the business. Obviously that's a greater value than the assets just sitting there waiting to be sold or not being utilised. Now there's another asset valuation method that you won't see discussed much in the textbooks, but it's a pretty common sense one. It's called the cost to create method. Now, this is fairly logical as well. If you're looking at buying a going concern business and someone wants $100,000 for it, and you say, well, I could set one up next door and it'd be just the same as that business and I can get it for 50. If the two businesses are the same, the one that I created, the one that you're trying to sell me, suddenly that one doesn't look like it's worth $100,000. It's called the cost to create. It's an asset valuation. There's no goodwill involved in this business, except maybe some locational goodwill attached to a lease, but it's the equivalent of what it would cost to create. And many business buyers at entry level and lower levels will ask themselves, is it value for me to go and buy this business, or could I create one just as easily? So we've just dealt with asset methods of business valuation. So let's come back away now to this original question that we asked, is the business making money? We've looked at circumstances where it's not making money. Now if the answer to our question is yes, it is making money, we still have to investigate this concept of special value. In other words, special value takes it outside the normal realms of business valuation. It could have special value that's greater than its value according to a profit method. Does it have special value? That's a fundamental question that should be asked at the beginning of each of these pieces of investigation. So it doesn't have special value. Okay, let's come down on the income methods. Now, there are two types of income we're going to look at here. One where the business is making wages for an owner, and one where the business makes wages plus profit, obviously dealing with larger businesses. So the first one, the business makes wages for an owner, but that's about all. You know, in business valuation, such a high percentage of businesses fall under this category. And there is a simple profit multiple for this type of business. It's called a PBIT multiple, which stands for proprietor's earnings before interest and tax. And all of our profits look at earnings before interest and tax. Now, simple profit method is a smaller multiple because the amount is higher, because it's boosted by the owner's wage. It's often called valuation method against owner's return, but let's just for our purposes call it the simple profit method using a PBIT multiple. So then what about when the business makes wages for owner plus profit? Generally, this profit is called earnings before interest and tax. Could be described as earnings before interest, tax, depreciation and amortization. So it's either an EBIT or an EBITDA that we're dealing with here. And most of the time you'll be dealing with this method, the capitalization of future maintainable earnings. Profit is adjusted for abnormal income or expenses, and the valuer multiplies that profit by a number according to the risk of those future earnings continuing into the future. There's another method that looks very much like this. A lot of people are scared of it, called the discounted cash flow method. Why are people afraid of this? Because you are asked to project income and expenses into the future for a number of years. Can be risky, but really it's probably more scientific and less risky than just picking a multiple based on what you think next year's income is going to be, and also assessing risk. So both of these methods are asked to assess risk and apply a discount factor in the case of a discounted cash flow. So then, to summarise, a discounted cash flow is a projection of income and expenses into the future, then determining what the profit is going to be each of those years into the future, and discounting that back to a net present value for today's valuation. So then finally, under the income methods, is the super profit method. Don't want to go into this too much here, it's not often used in the marketplace, but it looks at and acknowledges the fact that there are different income streams and different risks attached to those income streams, or asset classes if you like, within the business. So the super profit method looks at profit over and above the standard profit that you would get out of the business, and it really is another profit multiplier but applied to different income streams. Finally, we look at other sales in the marketplace. This is not strictly a method, although you might hear it referred to as the market method. The reason it can't exist on its own is because so many businesses are just so different that it's hard to get a line from one business to another. It's useful if you have enough statistics and the businesses are very similar to be able to draw a method simply out of the market method. I'll simply say this: considering comparable sales will provide us, if the sales are sufficient in number, with a good upper limit and lower limit, and hence a range within which to fix our business according to its particular circumstances. So the last area for discussion is this little fellow here called the rule of thumb method. Now, some professional valuers will completely disregard and discredit this method. What it is, however, it's a little helper. It's an indication. It's a beginning point. It will often not relate to profit. It might be related to sales of the business. You might get valuation of a real estate practice, property management section of that real estate practice based on a certain dollar amount for each dollar of property management income. You could get retail businesses where a bakery is valued on the bags of flour. You could get a insurance brokerage valued based on its ongoing trail income. So it's a check method. Just like the market method is a check method, the rule of thumb is a useful check method, but I doubt any decent business valuer would value just relying on the rule of thumb methodology. For extra resources including blogs and videos, go to valuabusiness.com.au or contact us on our Sydney number 029439 3399.